Hello everyone, welcome to this lecture 4 of the course Metrics and Analytics of Marketing. In this week we have been discussing regarding various metrics associated with promotion management. For example, we started with different aspect of price promotions, then we looked into what is baseline sales, what is incremental sales, how can we isolate baseline sales from incremental sales. Then we looked into various tools such as coupons, redemptions, and how we can measure various aspects of coupons, redemptions on our business performance. In today's session, we will try to look into another aspect of promotion management, some of the critical metrics associated with promotion management, and those will be covered under the topic of promotions and pass-through. So, let us dive more into what is pass-through and what are its associated measurements. Let us try to start our discussion with the very definition and understanding of promotional discount. What is promotional discount? Basically, it represents the total value of promotional discounts given throughout the sales channel. What do we understand by the sales channel? For example, how does a good move from the point of production to the point of consumption? It will be manufactured somewhere. Let us say, let us term that entity who manufacture it as manufacturer. Then manufacturer will give it to maybe some of the CNC or distributors. Distributors will give it to the wholesaler. Wholesalers will give the items, transport the items to the retailers, and the end consumers will purchase the product from the retailers. With the advent of information technology, with the advent of social media and various e-commerce site, nowadays the number of intermediaries are getting reduced, but yes, there are still some intermediaries and we need to understand the mechanism of these intermediaries. For example, in the process of transportation and in the process of taking the titles of the goods, each of the entities involved in the process of transporting the product from the point of production to the point of consumption, everybody will take their own margin. Similarly, if a discount is extended, then in that case the discount can be extended from the manufacturer to the distributor, from the distributor to the wholesaler, from the wholesaler to the retailer, and ultimately from the retailer to the end consumer. Let us say the manufacturer extend a discount of 20% to the distributor. The distributor will keep 10% of it for their own margin and 10% will be extended to the wholesaler. And then wholesaler will keep its own margin from the discount or extend another portion to the retailer, and ultimately the consumers will get some discount. So, remember that sometimes the intermediaries might top up the discount. For example, the retailer is getting a discount of 10% to attract more customers, to promote his or her own retail shop. The retailer might top up another 5% with it, and in a way the customers will get a overall discount of 15% instead of 10%, right. So, this process might continue. What we need to understand is like whatever discount is extended by the manufacturer, how it is reaching the point of consumption, that is to the end consumers. And that particular thing we will try to understand through a metric called pass-through that we will discuss in the subsequent slides. Now, another aspect of looking into various discount or various promotion initiative is that how popular is the initiative? Is it beneficial for the customers? Are the intended set of customers become aware about my promotion? Is the promotion initiative worth it? So, all these aspects can be seen through a metric called percentage sales on deal. Percentage sales on deal it measures the percentage of company sales that are sold with a temporary trade discount for some firm. Basically, let us say for a given period of time, I have collected a revenue of 1 crore, and out of this 1 crore, 50 lakhs has been on discount. I mean 50 lakhs revenue I have collected through discount, the product sold in discount. Then in that case, the percentage sales on deal will be 50%. This particular metric is an indicator of the popularity of your promotion. Remember that it does not directly tell you how much money you have made out of this deal. Sometimes, most of the time, whenever a discount is extended, whenever a promotion is initiated, for a short period of time, it will squeeze the contribution margin. The profit will be negatively impacted. But the thing is that we do it for the purpose of gaining something in the long run, probably to create some new accounts, probably to extend some bonus to our loyal customers. In this process, we also need to keep into account that some of the customers who would have bought the product even without the discount, they have purchased the product with discount because of the availability of the discount. So, that is an opportunity loss for the company. So, whenever we are trying to evaluate the percentage sales on deal, we need to take these aspects into consideration. We need to understand that it is an indicator of popularity of the promotional event. It does not directly tell you the profitability of that particular deal at that particular point of given period of time. Manufacturers offer many discounts to their distributors and retailers, often which are called as the trade discount or the trade, with the objective of encouraging them to offer their own promotion in turn to their customers. What is the expectation? Whenever I am trying to extend some discount to my wholesaler or retailer, then in that case what am I expecting? I am expecting that they will give me more shelf space. My brand will be more visible in their spaces. Second aspect is a portion of the discount will be extended to the consumers as well, so that consumers will become aware about our product more, consumers will be attracted towards our product more. Probably you have seen in some, whenever you go to a let us say departmental store, sometimes the person in the departmental stores, let's term them as sales executives, they will try to sell you from a particular brand, that this is the offer available for this particular brand, which will be over in which will be due in 1 month, right. So, in that case what they are trying to do? They are trying to promote a product from a particular brand, because from this brand they are getting some discount. If trade customers or the consumers do not find promotions attractive, this will be indicated by a decline in percentage sales of the deal. So, if I look at this particular concept as a metric, that is percentage sales on deal, if the percentage sales on deal is lower, it indicates that the deal is not attractive or deal is not popular, right. So, this is all about the overall overview of the promotion matrix, that is percentage sales on deal. Now, we will try to delve more into related metrics. So, let us start with the construction of this one, percentage sales on deal. As I said that this measures the percentage of the company sales that are sold with a temporary trade discount of some form. This usually would not include the standard discounts such as those for early payment or cooperative advertising allowances, accruals, right. So, basically some other form of promotions are there, this will not be counted as part of these deals. For example, if you make advance payment, if you make upfront payment, then there is a scheme that will give you, let us say 5% cashback or 5% upfront discount. So, that will not, this particular discount, this particular benefit will not be accounted in this calculation. Now, let us directly go into the let us try to directly construct a formula from the definition itself. What is percentage sales on deal? It is the sales with any temporary discount, maybe in terms of dollar or maybe in terms of units sold, divided by the total sales made in either in dollar or in terms of total number of units sold. This is very clear, very simple definition, very simple formula of percentage sales on deals. Promotional discounts represents the total value of the promotional discounts given throughout the sales channel. It incorporates the discount extended by the from the manufacturer to the distributor, the discount extended from the distributor to the wholesaler and so on, ultimately up to the level of end consumers. Now, another way of looking into promotional discount is that I can equate it to sales with any temporary discount, let us say in terms of dollar, multiplied by average depth of discount as percent of list price, right. So, how can I calculate this depth of discount as a percentage of the list price? It is what is the unit discount across the channel divided by what is the unit list price. So, this will give me the depth of discount as percent of list price. Let us say ultimately the average discount across the channels is, let us say, a 100 rupees product whose list price is 100 rupees, that the customer is paying 80 rupees. So, in that case the depth of discount as percent of list price will be 20%. So, this is all about the construction of the matrix percentage sales on deal or the promotional discount or the depth of discount as a percentage of list price. Now, let us try to delve into another metric which is very much related to promotional discount, is called a pass-through metric. As the terminology itself suggests, pass-through is nothing but what percentage of something is being passed through a particular channel to another entity. So, if I look at the dictionary meaning of pass-through, it is nothing but what portion of something is extended to some other entity through a particular distribution, through a particular channel. Now, in case of supply chain, in case of sales channel, it will be something like, it denotes the percentage of the value of manufacturer promotions paid to distributors and retailers that is reflected in discounts provided by the trade to their own customers. Overall, this kind of promotion, this kind of discounts can be divided into two categories. One is called the trade discount and another is called the consumer discount. Trade discount is something like when the manufacturer extend a discount to some other entity other than the end consumers. It can be a wholesaler, it can be a distributor, it can be a retailer. That is called a trade discount. Consumer discount is when any entity, it can be the manufacturer, it can be the distributor, it can be the retailer, they extend the discount to the end consumers, then it is called a consumer discount. So, now the question is, as we have understood that this is a channel through which the discounts are being passed through. Now, let us say the trade discount was 20%. Let us say the company is giving to its retailer, the manufacturer is extending a 20% discount to the retailer directly. Let us say there is no other intermediary in between. Then in that case the retailer is keeping 10% of it for their own margin and 10% is extended to the end consumers. Then in that case the pass through rate is, what is the total discount extended to the end consumer? It is 10 rupees. And what is the discount that the retailer got from the manufacturer? It is 20 rupees. So, basically the pass through rate is 50% here, 10 divided by 20. Pass through is calculated as the value of discounts given by the trade to their customers divided by the value of temporary discount provided by the manufacturer to the trade. I think I have already explained with the example of manufacturer giving discount to the retailer, and in turn retailers are extending a portion of the discount to the end consumers. Of the promotional value provided by the manufacturer to its retailers and distributors, the pass-through percentage represents the portion that ultimately reaches the consumer. Ultimately, what is the primary purpose of the manufacturer? To keep their customers base intact, to keep their customers loyal, or to acquire some new customers with some lucrative offers in terms of promotional discounts. So, if that has to be done, because they are not probably directly dealing with the customer, it has to be routed through some channel partners. And why channel partners will route it? When they get some benefit out of it, maybe in terms of keeping a margin of the total discount that is extended to them, or maybe in terms of they are trying to promote their own entity by the tool of discount extended to them by the manufacturer, right. Low pass-through percentage can indicate that too many deals or the wrong kind of deals are being offered. So, this is an indicator. If the pass-through rate is low, in that case, what does it mean? That the offer is probably not suitable, made suitable for the end consumers. Let us now try to construct the metric pass-through. As we have already understood that pass-through is calculated as the value of discount given by the trade to their customers divided by the value of temporary discounts provided by a manufacturer to the trade. So, in the numerator we will have promotional discounts provided by the trade to the consumers in terms of dollar divided by the discounts provided to the trade by the manufacturer. Fine. I think it is quite simple to conceive the pass-through rate. Now, let us try to understand the purpose of promotions and pass-through metric. The primary purpose is to measure whether the trade promotions are generating the consumer promotions or not. To understand whether the promotion that is extended to the intermediary are effective at the consumer level or not. Whether the benefit extended to the trade is being translated to the benefit of the consumers or not. If it is not, then probably we are not doing that great in terms of promoting our product or promoting our brand. As we know that middlemen are a part of the channel structure in many industries. If we talk about, in some of the industries it is less, in some of the industries it is extensive. For example, if we talk about FMCG industry, how many number of intermediaries are there? There will be a manufacturing plant, then from the manufacturing plant it might go to the CNC, then CNC will transport the products to the distributors, from distributors to wholesalers, wholesalers to retailers, and ultimately end consumers. In some other kind of product, let us say for some industrial product, the number of intermediaries will be lesser. But having said that, there is always an intermediaries who perform certain set of functions and who take the margin of the product. So, they will not perform the function for free, they will take a margin in the channel. So, for example, they can give you the time utility, they can give you the the middleman or the middle entity, intermediate entity, they will give you the time entity, they will give you the spatial utility. For example, let us say something is being manufactured in Gujarat, how can it be made available in Assam, right? So, in that case, these intermediaries plays a role, they helps you in maintaining the logistic, they help you in maintaining the transportation. In most of the time they used to take the title of the products by paying the amount to the manufacturer or to the back channel entity. So, companies may face 1, 2, 3 or even 4 levels of resellers before their product reaches the ultimate consumer, depending on the type of industry you are into. Let us say for example, a beer manufacturer may sell to an exporter, who sells to an importer, who sells to a local distributor, and who sells it to the retail store, and the end consumer will purchase the product from the retail stores. Different mechanism, I mean different kind of channel for different kind of products. If each channel adds its own margin without regard for how others are pricing, the resulting price can be higher than the marketer would like to. This sequential application of individual margin has been referred to as the double marginalization. Pass-through denotes the percentage of the value of manufacturer promotion paid to the distributors and retailers that is reflected in the discount provided by the trade to their own customers, right. So, I think this part is clear. So, basically what we are trying to conceive is that there are multiple intermediaries in the channel, and each of the intermediaries will derive some profit for their entity, and in this process the price from one point to another point will keep changing. Similarly, the discount from one point to another point will also keep changing. So, this is covered under pass-through metric. Let us now look into an example and try to understand how can we calculate the percentage sales on deal, how can we calculate the pass-through rate. During the off-peak months, Vietnam Airlines offered its agents a discount of 200,000 per ticket in their own currency. The price for one-way ticket Hanoi to Ho Chi Minh normally costs 3 million. You know why it is 3 million? Because the value of currency in Vietnam is very low. So, millions is not of a big deal for them. Okay. So, but now the first level agents would sell it with the price of let us say 27 lakhs, okay, per ticket, and it is attributed to the promotion. Remember that as far the promotion is concerned, it is a discount of 200,000, but they are topping it up with another 100,000 discount, and they are making the total discount as 300,000 discount. In this case, the examples that I have referred in ideal conditions are being different. In this case, in most of the cases, if a discount is extended, then some part of the discount will be kept by the intermediary. But in this case, what the intermediary is doing, they are also topping up with the discount. Okay. So, instead of extending 200,000, they are extending 300,000 discount and selling the products, selling the tickets at a price of 2.7 million. Over the year, 20 million tickets were sold, 4 million of which were sold during the period of the special promotions, means 4 millions were sold on discount or on the deal. Now, you need to calculate the pass-through percentage rate and the percentage of sales on deal for the year. Numbers are very much clear, we just need to put these numbers in the formula. So, let us first calculate the percentage sales on deal. So, what is the total sales made in the year? It is, what is the total sales made? It is 20 million tickets. And what is the number of sales that is made on discount? It is 4 million. And we know what is the quantum of discount, right. So, people who have bought the product, bought the ticket on sale or on discount, they have to pay an average price of total discount, I mean total revenue that is coming from the discount will be 2.7 million multiplied by 4 million tickets were sold on discount. So, 2.7 million multiplied by 4 million divided by what is the total revenue? 20 million tickets were sold. Out of 20 million, 16 millions were sold at the normal price, which is 3 million, and 4 millions were sold at a discounted price, which is 2.7 million. So, now the percentage sales on deal will be 2.7 million multiplied by 4 million divided by 2.7 million multiplied by 4 million plus 3 million multiplied by 16 million. This will give me a percentage sales on deal in terms of monetary value, and which as you can see the value is coming as 18.36%. Remember that we can also calculate in terms of units sold. So, if I calculate in terms of units sold, then in that case what will be the percentage sales on deal? So, how many units were sold on deal? It is 4 million. So, 4 million divided by what is the total number of units sold? It is 20 million. So, 4 million divided by 20 million, it is 20%. So, now you can see the difference. The percentage sales on deal in terms of revenue is 18.3% and in terms of units sold it is 20%, right. So, this means that 18.6% of the total company's sales in terms of revenue are sold as the result of the promotional program, right. Now, let us try to calculate the another metric, which is the pass-through rate. What is the definition of the pass-through rate? Promotional discounts provided by the trade to the consumers divided by discounts provided to the trade by the manufacturer. Now, what is the promotional discount provided by the trade to the consumers in dollar? It is, what is that? Basically total, what was the normal price? It is 3 million, and what is the discounted price? It is 2.7 million, right. So, basically the discount provided by the trade to the consumer is 3 lakhs in their own currency, and what is the discount provided to the trade by the manufacturer? It was 2 lakhs. Remember that, that is why it is coming as 150%, which is greater than 100%. So, if this particular value is greater than 100%, then in that case it indicates that the intermediary, which is an agent in this context, is topping up the promotion. Means the manufacturer or the another entity has offered a discount, and over and above that discount you are also giving some additional discount, so that more discount is extended to the end consumer. So, that is why the value is more than 100%. If it is lesser than 100%, then it indicates that whatever discount is extended by the previous entity to the intermediary, a portion of the discount is kept by the intermediary and the remaining portion of the discount is extended to the end consumer. If it is exactly 100%, in that case neither the intermediary is topping up the discount nor the intermediary is keeping a portion of the discount. It is passing the discount as it is, as it has received from the previous entity, right. So, this is an example of promotions and pass-through metric. Now, let us try to look into the types of promotions and pass-through behavior. So, what is trade promotion? Trade promotion is the discount or promotional initiative given by the manufacturer to the intermediary. It can be a retailer, it can be a wholesaler, it can be a distributor. And consumer promotion is something which is directly extended to the consumers. So, the intermediaries will have lesser role in, mediating the promotion. So, in case of trade promotion, intermediary will have the full control of mediating the promotion, but in case of consumer promotion, intermediaries will have negligible role. Now, let us delve in details these two types of promotion. So, as we have said that in case of trade promotion, it can be from manufacturer to the retailer. Some of the examples that we can look into is off invoice discount. In the invoice there will be a discount. Then there can be trade allowances given to the intermediary. Then there can be slotting fees and there can be temporary price reduction. So, these are the different examples of trade promotion. In case of trade promotion, as per the nature of the promotion is concerned, pass through is uncertain, because pass through is totally under the control of the intermediary. Retailers may pass full discount, means 20% discount is extended to the retailer, they will pass full amount of it to the consumers. They can pass the partial discount, out of this 20% they will keep 5% and 15% will be extended to the end consumers, and they can also keep the entire benefit as profit. They can just pass 0% discount to the end consumers, and sometime, as we have seen in the previous example, they can top up the discount. They will give additional discount from their own margin and make the discount more lucrative than it is extended by the manufacturer. Now, looking into the consumer promotion, as it happens directly between the producer and the consumers. Some of the popular examples of consumer discounts are, consumer promotions are coupons, rebates. In coupons, you can just have a code and you can direct redeem the coupon, let us say in a discount. Then rebate is something like after purchase you will get something back, and there can be another form of rebate, that is the cashback offer. So, these are some of the examples of consumer promotion. So, in case of consumer promotion, as it is a relationship, as it is a deal between the manufacturer and the end consumer, the pass through is very high, they get the direct discount. Discount is consumer activated and retailer has less discretion on it, as it is directly given by the manufacturer or the producer to the consumer. Now, let us ask a very critical question, that is why the pass through matters for the marketers. For marketers, it should be always revenue oriented. I am extending a discount, whether it is kept by the retailer or it is kept by the wholesaler or it is kept by the end consumer, how does it matter to me? Yes, it matters to me, because I need to understand the purpose of these discounts are being satisfied or not. Pass through determines whether the promotions actually stimulate the demand or simply subsidize the retailer's margin. Why do I promote a product, promote a brand? To stimulate, probably the primary purpose is to stimulate more demand. So, this stimulation is done or not, or whether it is just adding some additional profit to the intermediary, I need to answer this question. A promotion with high redemption but low pass through rate, what does it mean? If the redemption is very high but pass through is very less, in that case we can say that consumers are not getting the benefit, but these intermediaries are keeping the benefits entirely probably. So, it will have poor consumer impact. So, the organic demand for the brand or the product is not being impacted. Then low redemption but high pass through plus incremental sales. So, it can still be a profitable idea. Low redemption means less number of people are claiming it, but whoever is claiming, the benefit is not kept by the intermediary, rather it is extending to the end consumers. So, we need to analyze this kind of critical aspect associated with pass through. Whenever you are coming up, you are initiating a promotional event, in that case you need to understand what is the percentage sales on deal, you need to understand what is the pass through rate, and depending on the values of this matrix, you can determine whether the purpose of initiating this promotion is being fulfilled or not. We will try to conclude today's case with this one, with a bit of analysis on pass through and redemption rate. So, let us look at the metric and what does it matters. We are reiterating the concepts. So, as far as redemption rate is concerned, what does it say? It says whether customers use the promotion or not. Then what is its implication? How popular is the promotion? Customers are the customers finding it difficult to use the promotion? How easy it is to use the promotion. So, these kind of questions can be answered with redemption rate. Then through pass-through rate, we can answer questions such as whether the customers receive the benefit or not. Manufacturer extended some benefits, manufacturer initiated some promotion, some discounts, but whether it has reached the customers or it is being eaten up by the intermediaries. Incremental sales, whether the promotion changes the behavior or not. So, basically high redemption does not mean that high pass-through rate, neither high pass-through rate indicate that high profitability. This distinction is a strong academic talking point. So, you need to understand this distinction, you need to understand this matrix very clearly, you need to understand its impact on business analysis very clearly, then only you can come up, you can utilize this matrix for your informed decision making process. So, I will stop here for today. Thank you. I will hope to see you in the next class.